In our most recent video, we discussed the idea that debt maturity was going to become a big problem, and the Japanese yen continues to be a huge issue as it's spiking out of control, especially over the last 4 weeks. The markets don't seem to be responding to it just yet. Even with the US 30-year yield going past 5%, it hasn't been enough to take the market below its put wall. But could this change over the next coming sessions? And what happens if we go to massive negative gamma? In today's video, we talk about how close we are to these events and why everything matters in the potential of distribution. Also, money keeps flowing into those hedges. Guys, we've got a lot to discuss. Let's cover stocks, commodities, and cryptos right now together. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we have a lot to discuss. The latest macro, the data, and of course, the options flow, which became one of the most important factors of the last 24 hours. Let's kick things off though with where we're at so far. And you may be saying, is that a really blurry chart? Yes, it is. But what it does show us is it shows us that after the US trade, China kind of reduction in tariffs, that forced the markets to levels that we've never seen in terms of recovery off the first drop, and not to make an all-time high, and also to actually not go into a recession straight away. And this brings up a really interesting point. I thought we'd kind of go through it today together. In terms of when we see these types of reads, what happens over the smaller timeframes, and then what happens over the next 256 days. So, of course, resoundingly, everything tends to be positive across the board. 21 days later, though, or even 63 days later, that's where we've often had the problems. And I think the key point here that we want to look at is the fact that we've already seen huge amounts of breadth thrusts, Zweig breadth thrust, 770, DeGraaf, and even a Whaley breadth thrust. And all of these are really starting to say, of course, the markets are most likely going to do this. But at the same time, because the markets rallied so much, sometimes we will get pullbacks. And as you'll find out in today's video, there are some reasons why that could continue to happen, especially if we break this options level. Let's talk about overall US health for now. We do know that tariffs tend to front load demand, and that's kind of showing up here in US rail traffic. It's up over 2024, and we're still seeing quite strong growth for now. Now, could we be going into what's called the bullwhip effect? We'll talk about that in a subsequent video, so make sure to subscribe for it. But a bullwhip effect would be a pretty wild event indeed. Let's now talk about where we're at in terms of the first 100 plus days of Trump's presidency. Obviously, we're following the path that only a few have. And in all cases, generally, we were usually seeing some pretty strong recoveries. And then something was happening around that 225 days into the presidency. That seems to be kind of that marked event where we either go more of the decline and structure goes through, or we end up in the, okay, everything's all good, don't worry about it kind of phase. This will be an interesting chart, certainly one to be watching. So you're probably aware by now, if you've been watching the channel, or even if you've been looking at any of the news, that people are starting to get a little bit concerned about the bonds market, in particular yields. Now, we saw a 20-year treasury auction not do very well. It was actually one of the worst in years, and that caused everything to spike. But we've also had Japan and other central banks around the world seeing big spikes in yields. And this is causing some concern out there. And of course, the reason why is liquidity in Japanese bond market levels is currently at Lehman Brothers levels. Yeah, we haven't seen these kind of levels since, well, yes, we saw once over here, which ended up getting, fixed. And then, of course, the last time we saw it was 2008-9. During the heights of the global financial crisis. So what gives? Well, the issue with these overall really high yields, especially in Japan, is that but Japan's the number one creditor, so what's going to happen is people may bring back money into the country, and that can create a full liquidity, kind of stability issue across the world. It also brings up the question of whether we have a debt wall coming, which we've talked about a few times, and the debt wall is really this: 38% of all US treasuries needs to be financed over what's been going so far, which is, of course, the front load, 2024 into 2025, third quarter particularly of 2025 into 2026. So a lot of money needs to be shuffled. And it's not a question, I think, of whether treasuries can do it. It's really more probably a question of whether we will see the smaller companies be able to do it. So let's take a look at this chart before we go back over there to debt and talk about debt maturing for small caps in particular. The Russell 2000 faces a big challenge. Remember back in 2021 when no company had to earn any money? Well, of course, that's changed now. And what's occurred is we've seen basically businesses across the board that refinance themselves at really low cash rates have to do it again now. Now, if you know your Russell 2000, you'll know that 36% of businesses inside the Russell don't make any money. So how are they going to refinance come the end of this year? Are we going to see zombie business apocalypse? And usually I always say if somebody knows something's coming, then it's not necessarily going to become the issue. But, it still could be used as a narrative. And even then, there are other problems in the debt markets that need to be addressed. So just remember, huge amounts of debt being refinanced coming into the back of this year. Speaking of debt, we also have a couple of other problems going on right now. And one of those is Americans are falling behind on their car payments, and it continues to rise throughout 2025. And I'd say each number is going to get worse and worse and worse. And what does this mean? Well, we're at an all-time high here in terms of delinquencies. We don't necessarily, obviously crash in a market just because we hit these highs. I mean, over here, of course, the market's continuously rallied up. But it was kind of a precursor generally to some problems starting to arise. Maybe it's people are over-levered, people are losing their jobs and they just don't have it, and we're not seeing that yet in the economy. Who knows, really? But the main thing here is that most people have too much money and debt on their cars. And the reason is in 2021 and 2022, as we all know, people were paying over sticker value. So a lot of these cars are actually under their own debts. So effectively, people owe more money than the car is even worth. So how's that going to play out? The other one that I've seen come up recently is a buy now, pay later for your food, your fast food. You want to pay $30 at McDonald's? Well, guess what? You can do that now in 4 easy payments. Is that a sign of things to happen or things to come? Maybe it is. People are literally debting every single thing you can think of nowadays. Have you ever done that? Let us know in the comments down below, or if you know people that do buy their fast food in 4 easy payments. Let's now quickly talk about market sector changes. Obviously, we already knew that markets were turning defensive over the previous kind of 4 sessions. The last 24 hours, not that much change. We'll just quickly go over here again. You can see here that technology held up and some of the defensives started to get a little bit of rotation out of them, which could suggest that we're at that little bit of a support zone. But let's have a look here at the overall big dark pools and big trades. So we can see one large trade came in on the Qs over the last 24 hours. It's been quite a lot here. In the past, we've seen a lot of trades go through this exact level. Could this be a sell? It's possible, but we don't have, of course, that market making a new low, which we'll look at later on, because it could be that actually the NASDAQ is in a Wyckoff distribution. And one thing's for sure is we know there is a very key level, and that's the highs of 522. If we go back up and we break that in the future, that's going to be a really strong sign for market bulls, because we know that's a massive cluster. Huge amounts of transactions, lots of algorithmic style transactions coming through at that level. And at the same kind of time, we also saw VOO, the big S&P 500 fund, transacting in clusters as well. Not the same level of cluster that we did on the Qs, but certainly something happening. So what gives? Well, we have the RSI 70, which is obviously an overbought level. We have the bullish percent index on both the S&P and the NASDAQ back into those kind of extreme take profit zones generally for a trader or a swing trader. And that can suggest that we're in for a little bit of a pullback. So far, we've got 3%. Will we get the 6-7%? Yeah, seems plausible for sure. And we'll talk about that later on today's video if we break these key levels. And you can see here that in terms of smart money flow, smart money bought most of everything during that full dip. And then, of course, they've since then started to continue to purchase up, but they really were the winners of the dip itself. And of course, retail has been buying more recently as well. Retail just hit all-time records, 4.1 billion in US stocks purchased by midday on Monday during that dip. So remember, what did we see after that? Well, we've got the Tuesday kind of, rally, false rally into possibly sell off. We see all those clusters at these same levels. Could that be trapping in retail at least temporarily? And could it also be trapping in a bit of leverage? And leverage is absolutely through the roof at the moment. And that's fine. It can go higher for sure. This doesn't mean everything's going to sell off, but at the same time, it does show you conditioning. Look at that rally on the leverage like no other we've seen before. And that means that, no one's ever purchased more leverage quicker than what we've just seen. What about the overall narrative of markets? This is the one that tends to be overlining the best. I've got usually a 1960s or a 1990s narrative at the moment, both concentrated markets with, of course, very heavy stocks in them, which is what we've seen right now. And of course, speaking of concentration, the good thing about the rally so far, remember, it was formed through technology and through semiconductor stocks doing better. Let's have a look now at the S&P 500 charts. You guys can see here, central bank liquidity was slightly up over the last 24 hours, something to mark out. And of course, on the S&P 500, we stayed in a fairly tight range just above the put wall, just around that 58.40, 58.50 zone, and also around this 4-hour 20 moving average as well. Now, if we break below this, where do we go next? Of course, 56.60 seems like the most logical gap fill kind of zone, and there's a lot of stuff that's going on around that area. And we did see, of course, the first change of trend on the medium time frames for the S&P 500. We go over to the futures market. You can actually make a case for two things here. You've gone from a series of higher highs and higher lows to a lower low that's being formed. Then you've kind of come down to this really contentious put wall area, and you've seen a market that's rallied quite straight off it in the futures market in the morning. And I remember in our private community, links in the description down below if you want to join that, by the way, that I was talking about this yesterday, and I said, I don't think this market is going to want to sell today because it was coming in kind of red, and it just didn't seem correct with the way it's kind of priced up. So you could definitely make a case for bulls here to try to pressure back into 5900, 5910, which is the most traded kind of zone. And you could basically, of course, make the case for the bears. All we need is a daily close a little bit lower, and that's going to push, really almost nothing on the left-hand side holding it up. So that's going to be the breaking point you would have to think for the markets. Now, why is that? It's options. Look at this. Interesting ones over the next 24 hours. Some weird ones coming through at 58.80, 50 kind of 900 zones, so actually above current price. And that means that if we open even here, we'd be a negative gamma for the session. So take of that what you will. Of course, if we do break below 5800 is the first little stop for the next session. And if we take a look here at the 27th, you guys will notice 5800 becomes quite a struck put level. So we went from calls everywhere to puts very, very quickly. Last 24 hours, the put wall hold up. At the moment, will the put wall hold again? Basically just means we may move up another 20, 30 points if it's going to hold. But if we see that cascade effect, of course, that may need some epic hedging pretty quickly. Tesla stuck within the range 350 and 330. So we're stuck within that really, really tight range. And of course, Nvidia, you can see here 135, still the call wall, and 130-ish kind of is the puts at this stage, or even lower. But I would say if we do sell, 115, that most traded zone, maybe where we come back to. Let's have a look at charts. First up, we'll look at the VIX. The big thing with the VIX here is that it looked like it was kind of going for that second spike over here during the 56.60 phase of the S&P. Then we got the China news. And of course, we're doing the same kind of thing here. So what that could suggest is we're going to go for that second spike. And you might say, what the hell are you talking about? Well, generally speaking, when you've had a monster VIX, the market will usually like a pullback at some point. And these often come off oversold VIX levels. And yeah, we're at that oversold VIX level. So are we heading for the second spike? History would say it's usually around that right time. So we'll see whether that does happen. When we go over to the bonds market, you guys can see here, again, bonds are starting to spike up. Again, we're just getting that kind of temporary, upward tick potential here from the bonds market and yields. So that's something to look at. And then, of course, when we're looking at corp yields, you can see that, generally speaking, corporate bonds are holding firm. They're not really showing super degradation or total freak out or anything like that yet. US dollar, nowhere land. It's not below 99, so it's not broken to a new low, and it is sitting around support at this stage. And that means that we're, of course, also trapped with gold. So 33, 45, 40 area, that was the resistance we spoke about in the previous video. It's been resistance so far. If the market drops, 3,200 is probably going to be where the buyers sit. And daily close above 33.45, that's going to be a big zone because that's going to push possibly an all-time high for gold and obviously back to that 3,400 area. Silver, something similar, dropped off a bit, came back to a really heavily traded area, needs to get through 33.50 to really get the flows going. But as you guys know, the price is 34.50. We need to get through that. That is going to be a big zone for silver if it does occur. Tesla, in terms of moves, you can see here, if we were to go bullish, at the moment, it seems to be doing moves in legs and pullbacks in legs. So just remember, if we break the call wall, next stop could be 400 pretty quickly. At the moment, hard to tell exactly which one it wants to do. It's going to go with the market. So if the market chooses to sell, then of course we would probably be looking at something like 280 or something on Tesla. Now let's have a look here at Nvidia. Nvidia rejected the high. It actually stole the high and rejected. Pretty bearish looking signal, and it does suggest that there may be further selling to come. It's something we saw on the NASDAQ as well, and the semiconductors. So as you can see here, semis also weaker than the SPY recently. And that's just showing you that little bit of, okay, well, we're just going to do a little bit of take profiting or a little bit of, sleeping after what has been an epic rally. And that often comes and coincides with retail getting really bullish. And we saw that on that Monday with them buying the dip big time. You guys bought the dip big time that day. Google, nice breakout. However, it did reject during the session. Still like that fundamentals level. Chinese stocks, obviously still dull, still around the supply, still making a series of higher highs and higher lows. So I guess it's still in an uptrend for now. And the US 2K has come back to the support. It dropped heavily on that yield news because so many companies need to refinance. So it's probably the most, along with the NASDAQ, should be the most, susceptible to these yields. But in general, you can see the US 2K, the key for the bulls is 2120, and the key for the bears is obviously to press lower. Now, NASDAQ is probably the most interesting chart. You've got here this chance that this is actually a Wyckoff. So do we have some kind of, Wyckoff setup where we've got a buying climax, a UT, a UTAD, a fall below, a bit of a rally, drop, we find that close underneath, and then we go down to 20,000. Well, yeah, it kind of does look like a distribution at this stage. And if you go to like a daily chart, you guys can see here that big rejection coming off. Even look at the 2 hour here. Look at that rejection. So rallies. And remember, this is exactly where we just saw just tons of algorithmic pressure. So there was someone selling that level. And that's why in the future, if it is going to go bullish here, and this is where the bulls would be right now, under here with stop losses, then yeah, I mean, this level is going to be the one that you want to break to move, really forward to the next big zone. But at the moment, is it distribution? What do you guys think? Let us know in the comments down below. Bitcoin, on the other hand, not really too much weakness. It is continued on its way up, and it has broken all-time highs. The flows look good. I'll have that in the next video so you guys can have a look at the massive flow intakes here. But in general, look at those weeklies, very strong for the hedge. And when we first alerted to the idea that when gold does what it did, which was blow off top, then basically Bitcoin would start to rally. Well, boy, oh boy, has it done so. I mean, that is a very, very good statistic indeed. And it's continued to do so. So pullbacks at this stage will be met by bull demand. Could it still pull back 15 grand? Yeah, of course it could. It's Bitcoin. But it does look like if you hit that 95 again, that would be a pretty big buy zone for the street. So, and the street is in this, specifically the banks as well. Now, if you enjoyed today's video, please remember to subscribe, follow us over on X as well, and check out our Sydney trading event as well, which is on the 4th of June. It's going to be great. We're going to share some pretty in-depth knowledge there, and it'd be great for me to meet so many of you guys out there. I always enjoy meeting everyone in the community, and you guys enjoy meeting each other. And that's the big thing about it. We all have very similar kind of ideas about markets, and that can be hard to find out there in the world right now. So thanks so much for watching. You have a fantastic day. And we'll see you in the next one, guys. Bye for now.